If there is one thing that I hate about finance related content these days, it's when some bro with slick back, gelled hair is just sitting there pontificating about all these investment strategies that we all know he's not even using himself.
I'm definitely going to avoid hair gel. I didn't know you felt that way.
Avoid the gel.
But I do totally agree. I mean, come on, don't sit there and tell me about 60/40 stock bond ratios or bucket strategies when we all know you're not actually using them. One thing we can tell you for sure about this channel is that everything we talk about is based on investments that we are actually doing and are real numbers. We put our money where our mouth is. Or is it our mouth where our money is?
Uh, I think either way, it doesn't really sound very hygienic, does it?
It really doesn't.
Anyway, the first quarter of the year is already over, which means it's time to check in on our finances and see where we stand. Is the bear market killing our early retirement dreams, or is it actually helping them by allowing us to buy stocks at bargain prices?
The only way to know for sure is to look at the numbers. Now, on the one hand, our net worth is definitely down since the bear market started 15 months ago. We're down about 11.5%, which is actually a lot better than the S&P, which is down, I think, over 14%, but still nothing to be super excited about. On the other hand, we rarely even look at net worth because it's just not that relevant to us. We plan to live fully on dividends and interest income for our first few years of early retirement. So, what really matters to us is whether or not our passive income is going up or down.
And so far, we're happy to report that it's increasing.
Last year, our total passive income from dividends and interest was just over $40,000. This year, it's projected to be over 46,000. In fact, the income from just our two biggest investment accounts is already on track to be over 41,000. And then when you factor in interest from high yield savings and some short-term treasury bills, we're looking at another 5 or 6,000 for at least 46,000 in passive income for 2023.
So that's the general overview, but to really understand it, we wanted to take you guys under the hood and look specifically at how each of our investments are performing. You might remember the video we did earlier this year where we broke down how to invest during an inflationary environment. And it turns out we are actually following all the strategies that we talked about.
The biggest change we made is adding some bonds to the portfolio. We have never really invested in bonds in the past because interest rates were so low and bonds historically underperform stocks, so it just didn't make sense for long-term investors like us. However, with a recession looming and bond yields on the 10-year getting up above 4%, we decided to make a change. So I bought some 10-year, 5-year, and 3-year bonds. And as you can see here from the actual bonds we bought, that plan is working out pretty well so far. Thanks to the collapse of Silicon Valley Bank and the slowing economy, interest rate expectations have already gone down. So the value of the bonds has gone up. You can also see from these that when interest rates change, the longer dated bonds have the biggest reaction, either positive or negative. See here that the 10-year bonds have gone up more than 6% already, while the 3-year are only up about 2.5%. But both are headed in the right direction, and I'll probably wait for the federal funds rate to go down to around 2% before I sell these. There's obviously no rush because even right now, they're earning us a healthy 4% just in interest.
The other big change that we made this year is diversifying more into foreign stocks because they're cheaper than US stocks based on PE ratio and they offer a significantly higher dividend.
This is a long-term investment, so I'm not too excited about any temporary fluctuations. But for what it's worth, VXUS is up about 6% on the year, and it's paying a delicious dividend of almost 3%.
In terms of our other stock holdings, our main index fund, VTI, is up 7% on the year so far.
That makes a lot of sense because VTI is heavily weighted towards some of the big tech funds, and they've been making a good comeback in 2023. Our primary dividend ETF, SCHD, we're still buying more of it because as the price goes down, the yield goes up. And the dividend from SCHD is currently about 3.6%. That is tasty.
What is up with you and all these food references right now? Are you hungry? Do you need a little Pop Tart?
I might. I think I'm a little low carb today.
Somebody please get Adam a Pop Tart. And finally, Adam's 2023 spec stock Coinbase is up about 100% for the year.
Don't get too excited. This thing is volatile. That's kind of a characteristic of spec stocks. So we're saying that today as we're recording. By the time we post this, maybe it'll have gone to zero.
Blown up.
But that's what spec stocks are supposed to be. Now you might be saying, dude, why don't you sell half of it? Just play with house money. But the way I do spec stocks is I'm expecting them or hoping that they'll go up a lot. And so maybe if it gets up to about 200%, I'll sell 1/3 and then be playing with house money. But the point of spec stocks is the kind of big win. And so that's just shares that I'm holding on to for now.
We'll check in again about Coinbase next quarter and let you guys know how it's going. Who knows? Maybe Adam will be sitting here in tears by that time.
Let's hope not. But if I am, that's probably a good thing because we learn as much from our mistakes as we do from our triumphs. That's why we always give you guys our real investments and our real numbers.
So we hope you enjoyed that little quarterly update. So far, I would say things are looking pretty good for our early retirement dreams, huh?
Yeah, I would definitely say so.
Yeah.
Let us know what you guys thought. Any questions, any advice? We love hearing from you guys. We really like this as a forum for the exchange of ideas and appreciate all of your feedback.
We'll see you guys next time.
See you next time.